Hello, everyone. How you doing today? So I had an amazing conversation with the CPA Saturday morning. But his name's Bob Langworthy from Maine Bean Counters. Maine is in the state. You can check him out, mainbeancounters.com. But during that discussion, we talked about rising capital gains. We talked about potentially losing the stepped up basis and the 1031 exchange. All of the things, kind of the goodies of real estate. And from that, we had a discussion about seller financing and how seller financing could get the seller more money, lower taxes, and maintain monthly income. Because if they don't use seller financing, they're going to get crushed by taxes, just crushed. So that interview was posted on this channel. It will be up for about 48 hours, but it was really created for my course, How to Get Started One Rental at a Time. So that conversation may not still be on my channel. That said, I did want to go back because it is so powerful. And I realize not everyone can afford the cost of my course, but I still wanted to give you value. So I wanted to streamline the story and just show you the math. Again, I'm not a CPA. I'm not going to do your taxes. Again, reach out to Maine as in the state, mainbeancounters.com if you want to have those discussions. But let me just show you the power of seller financing and the fact that we need to get comfortable having these discussions. And if you want to see that interview, you want to see all the amazing stuff, you need to buy the course, How to Get Started One Rental at a Time. And of course, we're adding more stuff, subject to and house hacking and all of those amazing things. But I digress. Let's give you the example. All right, so let's make this a little bigger. We're just going to walk through a story together. Again, so this is seller financing will be huge, even more valuable if capital gains go up, if 1031's lost, if stepped up basis is lost. Let me make my picture here so we can look at each other. There I am. How you doing? Actually, you know what? Let's move me over here. Oh, Zoom, you're so flexible. Okay. Oh, sorry. I was at the bottom. Here we go. There it is. Okay. So again, please consult a CPA or an accountant to go over specifics. We're going to go over the rough numbers of all of this. The accounting, the tax code is very sophisticated. It is a graduated tax scale. Too much stuff to put in a quick 10 or 15-minute conversation, but I do want to give you the big pieces. First and foremost, this is going to be a very simple example. We are going to miss a lot of the nitty-gritty facts. If you're experienced in real estate, it will be obvious to you, but let me highlight some of those. We're not going to talk about land value, right? When you buy a property, there is land value or lot value, and then the asset land value doesn't get depreciated. We're going to ignore that for this discussion. You obviously know there are graduated income taxes, right? It starts at 0 and goes up to 39%. There are some states that have state taxes on capital gains and others that don't. There's a lot of subtleties, a lot of sophistication in the tax code. So talk to a CPA. So here is the example. We're going to highlight how seller financing can get more money, pay less taxes, and maintain income in this example. So here's the setup. An owner bought 4 rental homes 30 years ago. We're going to assume 30 years ago, which would be what, 1991, that they paid $50K for them. In this example, we're going to assume that today they are worth $400K each. Again, these are just examples. Use your own if you want, but here is the idea. And again, back to the nitty gritty, we're going to assume no capital improvements, which just wouldn't happen, but it gets too complicated if I say there's capital improvements here and there. Very simple example here. So here's the deal. The owner wants to sell all 4 at one time, and they are willing to give a small discount because they are done, right? 4 times 400 is 1.6 million. What they are going to do is they're going to sell it for 1.5, looking for a cash buyer. So they're going to give that cash buyer a discount. And in today's market, this probably sells, right? This probably sells pretty quickly, assuming there's cash flow and all of that. Again, remember in this case, there are some facts. He or she has depreciated the house to 0. right? One of the factors in the IRS or in the tax code is you can depreciate the house 1/27 and a half. Again, talk to your CPA every year. He's owned them 30 years. So again, it's depreciated to zero. We are not talking about land value, remember. Again, we're also going to assume in this case that their only income, because now they are done, is Social Security. That's their only monthly income. This is where one wrong move can destroy them, right? You think about this, right? They have they're going to sell houses for $1.5 million. All they have is Social Security, and they think they're going to have a bunch of money when this is left over. I have bad news for you. If they do this wrong, they're going to have nothing close to $1.5 million. This is tragic. Don't let this happen. So again, option one, sell 4 houses, 1.5 cash, done in 10 days, off and running, right? That is one option. Here's the deal. The tax man cometh. The tax man cometh. So again, talk to your CPA about the details. But again, going back to Bob Langworthy's discussion, main bean counters, he or she's going to pay what's called depreciation recapture. 4 houses, 50 grand, depreciated to zero. They're going to owe about 25% on the first 200 grand. It's called depreciation recapture. They're going to owe $50,000. But here's the killer. Because they sold that in one calendar year, even though they only have Social Security, they're going to be looked at as millionaires for that tax year. So if they happen to be in California or New York, which they probably have to be, if they bought for 50 and it's worth 400, they're going to owe as high as 53% on the capital gains, which in this example is 1.3 million. So 53% times 1.3 million in gains means they owe the tax just in capital gains $689,000. That's federal and state combined. Ouch. Ouch. So if you do the math, $1.5 million comes all the way down to 761,000. Depreciation recapture, capital gains, they are left with 761 grand. That is nowhere close to 1.5 million. They lost over half to the tax man, or almost half. They own the property 30 years and they're cutting in the government for 50%. That's not okay. Not okay. What if you and I can fix this by understanding seller financing? How about this example? You know what? I don't want a discount. I want to pay you $1.6 million. I want zero down. I'm going to pay you 5% interest for 20 years, fully amortized, which I did the math on one of those online calculators, is $10,559. Okay. At the end of 20 years, I own the properties free and clear. And they are, the loan is closed. Again, zero down. You can negotiate whatever you want. The seller financing deals are up to you to create win-win transactions. Obviously, as the buyer, you need to make sure it cash flows. Don't do alligators, negative cash flow, all of that. This story is about making it good for the seller. So what does the seller get in this example? What does he pay in taxes? When's the money received? All of that. So first and foremost, they're going to still owe 25% depreciation recapture, but it's paid slowly over years. It's not paid 50K year one. It is paid very, very slowly. Second, capital gains tax is much, 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 much lower, right? If this is a married couple and have some deductions and all of that, there's a chance that they pay zero, right? And if they do pay more than that, it won't be the 53% variable. Talk to your accountant, figure out where you are, Capital gains as it's currently could go from 0 to 53% when you add federal and state. If the deal is structured correctly, the seller could pay 0 in capital gains. And remember last time they paid $689,000. 0 or 689. Which one do you want? They will pay some interest because again, they are the holder, right? Part of that payment, that $10,559 is interest and part is principal, right? So principal, they will owe capital gains on. Interest, they will owe interest, right? It's taxable. It's interest income. So again, do the math with your CPA, but get comfortable with this story. Other things to note, the owner of that building, first off, you agreed to pay 1.6, but do you know how much money they collect? They're the bank. They collect $2.534 million over 20 years. And they paid a lot less in taxes. And they had monthly income for all 20 years, which will make them a lot more enjoyable to be around, if you know what I mean. Seller financing has always been huge, but if capital gains go up, if 1031 is lost, if stepped up basis is lost, seller financing is going to be more and more important. So if you want to be a part of this, you want to understand all the things, compare deals, and talk about seller financing, you need to buy the course, How to Get Started One Rental at a Time. It's all in there. We are adding more and more sections, house hacking, self-management, Airbnb, more and more stuff. But again, it all starts with understanding the deal, understanding what average is, doing the daily work, and just getting after it. And if you do buy the course, join the community. One rental at a time works. You'll be around other amazing individuals. Introduce yourself, have some fun. Have a great day. Bye.